Hi, and welcome to another video blog installment on chrisryan.ca. During my time as a realtor, I'm running around talking to lots of people, and I have lots of clients and lots of friends, and get introduced to a lot of different folks in different industries. And sometimes we'll sit down over a coffee and they'll actually start to explain a certain topic or whatnot that I'm not aware of. Sometimes I think that, wow, I think other people should be aware of this too. So what I'm going to start to do on a somewhat regular basis here on the blog section of chrisryan.ca is I'm going to invite the people that are the authorities of that specific topic, whatever it may be, and I'm going to do a blog post specific to that topic, so then we can make the general population here of HRM aware, and you can share this link with your friends and family. So I have Patricia McDonald here with Sun Life Financial, and she's a friend and past client of mine from a real estate transaction, help her buy a house. And she used to work at one of the big 5 banks, we're not going to tell you which one, but now she works with Sun Life. So the topic of discussion today, quickly, is going to be mortgage insurance. When you're buying a house, during the signing of the documentation before you close, the banking representative will say, would you like life insurance for your mortgage? And most of us are responsible, and we kind of look at each other, like myself and my spouse, and we said, oh, okay. And it's $60 or whatever it is every month, and you go, okay, that's fine, you sign it off. But you really don't have a true understanding of the terms and conditions and how it works, and the beneficiary and all that stuff, what you get, basically, for your dollar. So Patricia and I were talking recently, and she's actually going to explain to you her personal experience, and that there's a lot of opportunity out there for people to get the same amount of coverage for less money, or more coverage for the same amount of money that you're currently spending, or possibly less money as well. So it is a conversation that should be taking place. And the good thing with Patricia is that she's going to have that conversation before you're signing documents, not during the signing meeting, which is a little stressful for most. So I'm going to turn the floor over here to Patricia, and she's going to explain to us her personal situation with regards to this. Use yourself as an example, and we'll go from there.
Thanks, Chris. So yes, I did work at the bank, and when I got my mortgage amount was $168,000, and the insurance premium for life insurance for myself and my husband was $66.75. The way that the life insurance works through the bank is that your premium is set at the time of your mortgage, but it only pays out the mortgage balance if something does happen. So as you can see by the graph that I did here, it is a declining balance. So over the years, say, in year 15, you have $20,000 left on your mortgage, that's the amount that gets paid out. Through becoming life insurance licensed and working for Sun Life, I now have $500,000 of coverage. It's actually $510,000, but we'll use round numbers, for $33.75 a month. And as you can see, that is pretty much the same. If you split the premium through the bank in half, it's almost exactly the same. Now, I do want to say that it is not always the case. One of the other things is that the underwriting itself, is done at the time of application with Sun Life. So what that means is that you know for sure whether or not if something happens to you, if your beneficiary is going to get that money, it's because they've gone through and done medical tests and questionnaires and things that they need to do to make sure that you're approved for the insurance amount that you've applied for. Through the banks, they don't do the underwriting until the time of application. So what that means is that you could have paid your premium for 20 years, and the bank says, oh, sorry, we never would have approved you, so therefore you don't have any coverage and you're left with an outstanding mortgage balance. The third main thing is the beneficiary for the life insurance policy at the bank is actually the bank themselves. So the money does not go to your beneficiaries and your loved ones that you want to be protected. It actually goes to pay out the mortgage. Yes, it's gone away, but there's better coverage out there, and that's what I'm here to tell you about. The beneficiary for your life insurance policy with Sun Life Financial is whoever you choose. So it could be your family, your children, a really close friend, whoever you want to be protected if something does happen and you pass away or you become critically ill, and you don't want to pass on that burden. So
perfect. So in summary, you can either get the same amount of coverage, possibly for less. You can get more coverage, possibly for the same amount of money you're spending now or less. And also, you know exactly what you get when you sign. rather than waiting for the due diligence of the bank later on when something unfortunately may happen. The other thing too that I wanted to mention, and you can correct me if I'm wrong, is that even if you're in a current mortgage, you're in a fixed term mortgage, you can still change this and not be financially penalized. Is that correct?
Yes.
Okay.
Yeah.
So, good information. Please pass this on to other folks that you know. And if you would like Patricia's contact information, please click on the below comment button, and you will see all of her information there, email address, phone number, and so on. Thank you very much. Thanks.